Okay, guys, today we are going to be talking about credit. You'll notice we skipped 7.1 as we enter this unit. 7.1 deals with needs and wants, and I kind of covered that in other things and other lessons before. Needs and wants and putting together a buying plan. So we kind of sandwiched that into the budgeting unit. So today we're going to be talking about the most important area, which is credit and credit cards and lending in particular, and how compound interest can work for you or in some ways against you. Well, credit, it's the ability to borrow money with the agreement to pay it back later. Credit comes from the Latin word credice, which means to trust. So if you have good credit, it means I trust you will pay it back. Now, the debtor is the person who is borrowing the money. The creditor is the person who is lending the money. Now, in the process of taking out a loan, they're depending on what you're borrowing, depends on how much contact information they're going to get from you. Now, a lot of your information is already held at the credit reporting agencies. So, with a name, social security number, they can get a lot of information about you. But you're going to need to fill out a credit application, depending on where you're borrowing from. If it's like a store credit card and the credit card limit's like $200 to $500, you can usually get approved very quickly. If we're looking to get approved for a higher value than that, then they're going to need, job history, pay information, maybe tax information as well. So depending on the application, your credit limits will vary, and your interest rates can vary greatly. Now, when we go to apply for credit, we're going to need a lot of information with us. So, of course, personal contact info, which you already know, but you need proof of this. So, where you live, what your phone number is, your date of birth, work info, so pay stubs, income, time at your job. Now, what you're going to find is a high level of income is often good, but job employability is another. So if you are bouncing around from job to job at 6 months here, 6 months there, it doesn't look stable. So rather, a lower income at a job for a very long period of time is actually viewed as safer to the lender. So we're also going to need our banking info, so checking and savings, to see what funds are available there. Now, the creditor's also going to want to know who else do you owe money to, or who else do you have credit lines with. So owing money and having a credit line open are different things. Credit line means I have the ability to borrow a certain amount, and on my credit card I could actually have a certain amount already borrowed. Now, when you're filling out the form, be honest, be truthful, because anything that comes back as false will probably kill the loan or the access to capital. Now, my job is to show you the risks of credit, but using credit the right way could give you access to very cheap capital. So we're not going to avoid credit. We're not going to, have a shoebox of cash under our bed to pay for everything. We are going to access this market. We're just going to know the risks. We're going to know how they make their money, and we're going to do our best to avoid getting into traps. Now, one of the first accesses to the credit market when you get your first apartment, or you're in a dorm and you're setting up one of these accounts, this is a service credit. Service credit. It's the ability to receive the service first and pay for it later. So when you sign up for the electric company, you're going to start using your electricity. At the end of the month, they're going to tell you how much you used and how much it costs, and then send you a bill for it. Gas company, water company, sewer, utilities, they all work in that same manner. So you're getting the service first, and then you find out the bill later. It's a little tough with electric and gas because you don't know what the current price is as you're using it. So sometimes we can get sticker shock when we open up our bill. Now, cable, typically you sign a contract, although the cable company is very adept at sneaking in new taxes and fees so that your bill jumps around a little bit, but you are using their service and paying for it later. Technically, doctors and dentists operate the same way. We go in, we might do a copay, but we don't get the actual bill until we know what the doctor's performed, what tests, what medication, what anything like that. So we go in, we get the service, and then eventually we get the bill, and that's going to be a service type credit. Now, the one of the easier ones to access the market, and it is both can be a dangerous yet very powerful way to access the market. I'm going to say do not avoid getting a bank credit card. We do need to establish a credit history, and bank credit cards are the easiest way to get that going. Um, so what we need to understand here is that bank credit cards are usually attached to either Visa or MasterCard. So you might get a Chase Visa account or a Citi MasterCard account. That means the bank itself, Chase, is lending you the money, but Visa is the one who's processing the transaction. Now, Visa doesn't take the credit risk. Basically, they just get 2% of every transaction that happens all over the place. MasterCard as well. American Express also does that with some of their cards, although they were typically, they came to be a power in the charge card arena, which is slightly different, and I'll explain that later. Discover also, they actually process their own transactions and do the lending. So they do get revenue, but they do take loan risk as well. So what we're doing here is after you filled out your credit card, your application for credit, they've pre-approved you for how much they think you can spend in a month and pay back on time. Now, they don't really share the formula with us, and they typically give you a larger credit limit than you really should be spending. So we're never going to go anywhere close to our spending limit. Actually, 20 to 30% of your spending limit is probably where you should cap yourself. Now, you can spend on anything you need, and then at the end of the billing cycle, they send you a month. End of the billing cycle, they send you a bill. You have 25 days from the receipt of the bill to pay without penalty, late penalty, or interest. That's called a grace period. So as long as you pay your full balance, if you borrowed $200 and you pay it back in full on time within those 25 days, they can't charge you any interest or any late fees. So essentially, you can use free money if you use it properly. Now, the thing is, they are structured as revolving credit. So if I spent 200, I don't need to pay all 200 of it back. Okay, I can do what's called pay a minimum balance, and at least I'll avoid a late fee. But anything that I don't pay off will revolve into the next month and get added to my bill or my balance. Okay, so when we talk about revolving credit, the entire debt or part of the debt may be paid each month. But if we don't pay everything off in full, interest will start to accrue on any unpaid balances at the end of the month. And the interest that they charge is extraordinarily high. It should be in the realm of loan sharking, but that's for another talk. Now, store accounts. These are operate in the same way as a credit card, but can only be used in the store that they were issued. Now, many times companies that it's funny when I did this, Kohl's, Macy's, Shell, Sears, a few of these companies on this list are going out of business. It was a very good profit center for them, but as people shifted away from these types of cards to the bank credit cards, they lost a lot of their income. Now, the store accounts can be set up as a revolving credit, like in the credit card above, or they can be structured as an installment credit. So let's say I went to Macy's Furniture and I bought a sofa, and let's say it's $2,000. Now, what they can do is break that payment into 12 equal payments. And as long as I pay that off by the end of a year, then there's no credit. And when you hear commercials or see advertising for zero interest on this on all furniture until January of 2021, that's basically those are those deals that were structured as installment credit. So they're broken into equal monthly payments with a fixed time schedule, and as long as it's paid off before that end date, no interest will be charged. Now, many times I've set these up because I was going into the store, let's say, to buy a sofa from Macy's. I signed up for the card and got an additional 15% off. So when you're making a big ticket purchase like that, an additional 15% off is great. And then I never used the Macy's card again. Did the same thing for Sears when we bought kitchen appliances. Made the purchase, got 15% off for signing up, and then never used the Sears card again. I have used my Kohl's card before, and only when it's attached to any type of discounts. Now, charge cards. Charge cards are similar in structure to credit cards, but you can't carry a balance from month to month. Now, so the balance must be paid in full by the end of each month. So the charge card company really makes their money off of annual fees. Now, some of the lower end cards start with annual fees from $50 to $100, but some of the American Express, like Platinum, Black cards, their yearly fee could be like $500 or higher. Now, if you use that card the right way, you could get that value added back in your purchases. So, like American Express has a lot of upgrades for airlines, so you could get upgrades to first class, or you could get sit in the VIP lounge, or upgrades at your hotel. So depending on how you use your card, you can get a lot of value from the annual fee that you're paying. I stay away from annual fees just because I'm not someone who travels a lot, so I stay away from those types of cards. My cards that I like are the ones that pay cash back. Now, loans are another way to access the credit market. Now, banks, other lending institutions offer loans at interest. We're going to talk about some of the other ones in later lessons. But an example could be an auto loan, a small business loan, a mortgage, payday loan, and pawn shops. These are your lenders of last resort. And since they know no one else will lend to you, the terms that you will get are quite awful. Now, when taking out a loan, it could be secured or unsecured. Unsecured means I'm just borrowing against my good name and my credit score, but a secured loan comes with lower risk to the lender, so your interest rates are a lot lower. But a secured loan requires collateral, and that's some kind of property that has value. Okay, so if you fail to pay your loan, then the lender can repossess your property. Now, auto loans have low interest rates because they are self collateralized. If I don't pay my auto loan, they repossess my car. Mortgage rates are very low because they are also self collateralized. If I don't pay my mortgage, then they repossess my home. But a personal loan is not secured. It's not secured, so the interest rate is quite high because there's a lot more risk to the lender. Now, a line of credit means I have something of value. I want to borrow against it, and I'm not actually borrowing yet. But what the bank says is they've realized you have this much value in your property, and in the future, if you would need to, you can borrow X amount against it. Okay, so a home equity line of credit is a very common one. It's called a HELOC, home equity line of credit. If I have a value in my home, if I have a part ownership in my home, and I can borrow against it to maybe redo the kitchen or put an addition on the house or something like that. I don't necessarily have to borrow, but it's available should I need to. All right, now the benefits of credit are huge. Most of our economy is built off of credit. Actually, our money is created off of lending. Only new money can be created if somebody is willing to borrow it. Well, credit comes with convenience. Okay, you have access to a lot of spending power right in your pocket in a tiny plastic card. It's attached with rewards and discounts, cashback, travel, miles, merchandise, etc., etc. So spending you would have done anyway if it was already in your budget. Why not put it on the card if you already have the cash in the account to pay the loan back? Um, it can increase your spending power. Okay. Also, records and protections, I think, are huge. So I can see the records of my spending. At the end of the year, I get a report from my credit card that tells me what I spent on in every, whether it was travel, tourism, auto repair, schooling, education, groceries, restaurants. It breaks everything down, so I have the records to see it, and it helps me budgeting in the future. It also it has a little protection. So if they have a fraud and security department, if they detect any transactions that don't look like it was me, they can freeze the card, and then we'll get a new one. And then it's a little bit of a pain, but I'm not liable for any fraud stuff. So they have with their record keeping and protection, very very powerful tools there, and worth it. Now, the other thing is we are building credit history as we borrow. Um, Now, yes, if we have a lot of assets and we have a lot of income, we look like a low risk, but you need to have a credit history. That means years and years and years of borrowing money and paying it back in full and on time. That's how you build your credit score. The longer your credit history, the less of a risk you are. Now, you don't have to be borrowing huge amounts. If you borrow $20 a month on your credit card and pay it back in full and on time, your credit history will start to build, and your credit score will go up. I strongly recommend getting a credit card, but using it very wisely and only paying for things that you have the cash to pay for already. The cons of credit, though, are quite high. The interest rates and fees are extremely exorbitant. They make a lot of their money off of fees, so you need to know your contract front and back. Never pay anything late. Try to pay everything in full, and don't go over your limit. That's where they make the bulk of their fees. Now, the other con is because I have access to all that spending on a little plastic card in my wallet, impulse buying can be a problem. Okay, it's very easy to just swipe and I'll pay for it later. Now, there's good use of credit and there's bad use of credit. So, not all credit is bad if it can do one of two things. So, if your debt spending can lead to higher earnings in the future, then it's worth it. So if I'm borrowing to go to school, if I'm going to college, well, a degree should lead to a higher level of income. So that debt um, uh, makes sense, but it depends on how much debt we're getting into and what career as well. But if your debt can lead to higher levels of earnings in the future, then it's a good use of credit. If it can lower your costs in the future, it's a good use of credit. Now, this link I'm not going to use because I think it's a dead link, but it went to a women's watch page where I think the wristwatch was $98,000. I will double check to see what that price is today. Now, that is probably not a great use of credit. If you have the cash and you want to treat yourself, be my guest. But if you have to borrow in order to have a watch that doesn't keep better time, but is more of a status symbol, then that's not a good use of credit. Now, $16,000, let's say for solar panels, that makes sense, okay, because your future utility bills will be lower. So eventually, your costs for electricity will be lower as long as you own the panels. depending on how much electricity you use. If you generate more electricity than you use, you can actually sell some back to the grid. So this could actually lead to high levels of income. Now, let's talk about your credit score. And the best way to think of it is it's your adult report card. It tells lenders what kind of a credit risk you are. High credit score, so something like in the high 700s, low 800s. High credit score means I'm a low credit risk and I will get charged a very low interest rate. If I have a mediocre credit score, a poor report card, people don't want to lend to me unless they're compensated. So your interest rates are going to be a lot higher. Now, the 3 C's of credit. Okay. So character is basically from your credit history who you are. Have you used credit before? Do you pay your bills back on time? Are you honest? Are you reliable? Will you repay if we lend money to you? Also, do you have any stability? Like, do you live at your current address for a number of years, or do you move every 6 months? Do you job hop a lot, or are you employable? Okay, so these all reflect, do you have character? Okay, and if you do, we typically get lower rates of interest. Capital, do you actually have personal property? Do you have assets? Do you have investments? Is there anything that you can use that you can sell to repay the debt if, let's say, you lost your income? So having some capital, having some assets could be viewed as very good when applying for a loan. And then capacity. Okay, capacity means, do you just have any ability to take on any more debt? So you could have a high current salary, but you may already have a lot of loans outstanding. So if you had the high current salary alone and no debt, then you have a lot of capacity to take on new debt. If you have a high current salary and you have a lot of other loans that you also have to pay, then maybe you have a lot of income, but not enough wiggle room in your budget to take on any more debt. So in this area, do you have the capacity to pay anything back? So we look at areas of who depends on you, or your kids going to college, wife, house, like all kinds of things. So this refers to, do you have the ability to fit it into your budget? So we have character for who you are. Do you show a history of borrowing and paying back on time? Capital, do you actually have assets that have value that can be sold to repay debt? And capacity, do you have the income and the ability in your budget to pay things back? Okay, now there are things that we're going to do to keep our credit score strong, and many of them are common sense, but it pays to go over it. So we are going to use credit cards, but we're going to use them the right way. My suggestion is, if all my credit card spending are things that were already in the budget, so I already have the cash to pay for those things. So every time I go to the grocery store, it's going on the credit card. It was in the budget. Every time we get gas, it goes on the credit card. It was in the budget as well. So if it's on the budget, it goes on the credit card. And if any purchasing is done off budget, then it's going to be done in cash. Now, don't reach or go beyond your limit. There's actually part of your credit score that is how much of your credit limit are you using. So my recommendation is stay below 20 to 30% of whatever your credit limit is. So if they're going to extend me a credit limit of $1,000 a month, I might only spend $200 to $300 on that card. We always want to pay our balance in full, but sometimes I understand that just can't happen. There might be a life event, an emergency that had to go on the card. We're going to pay as much as we can towards that balance, because any balance that rolls over starts earning interest at a rate of 26% or higher. don't pay the minimum if you can. If I realize if that's all you can do, make sure that the minimum goes in on time, because that you can at least alleviate yourself from a late fee, but the interest that will accrue will be substantial. Um, Pay your bills on time. I'm going to recommend, since the credit cards have been implicated in the past of some shenanigans of where they would receive if your bill was due on the 15th, they would receive your bill on the 10th, but not cash it until the 17th, and then claim you were late and then hit you with a $35, $40 late fee. So my recommendation, go online, set up automatic withdrawals, and pick the day. You can go right up to the day before your due date. But I would make sure that it comes out of your account and into theirs electronically with a timestamp before your due date. And that way you can avoid paying any late fees. If in the event that you're going to have a problem paying, contact the creditor immediately instead of a payment plan. Many times they can freeze your card so no new transactions can go on, and then you can steadily pay down the old debt until you get it down to a level where you can manage it again. Simple things like if you're moving, let your creditors know as soon as possible. In the event of you moving, around and not letting them know where you are, that seems like shady behavior and can lead to problems and headaches. The second you think your card is lost or stolen, report it immediately to both the creditor and the police. And once it's reported, any transaction that occurs after that, you are no longer responsible for. Okay. And in the short time that a card can be stolen, a lot of damage can be done to your credit score. Now, you're going to review your credit report periodically for accuracy and report any errors immediately. Now, credit reports are available free for once a year. I wouldn't get them all at once. I would spread them out during the year. There's also some, I think, Free Credit Report or creditkarma.com has a lot of free services where you can get a lot of your report broken down for you. The last thing is establish a consistent work history. So records of employment and being employable are going to be very big in your credit score. So again, we came back to credit rating agencies. There are three: Experian, Equifax, and TransUnion. So I'm allowed one free report from each of these per year. So let's say maybe in January, I get my Experian report, check it to see if anything's on there. 4 months later, I get my Equifax, and then 4 months later, I'll go get my TransUnion. That's a cheap way you can do it, but there are paid credit monitoring services that can analyze your report, and anything that new goes on, you'll get an alert and say, was this you? And sometimes they can help you in fighting against something that shouldn't be on your report. When errors occur on your report, and they happen often, they are very difficult to get them removed. Now, that's your credit report, which shows all the activity and all the accounts you have open. But then there's your credit score, which is good to just know that if your score is consistent from month to month, then there's not a lot to be worried about. If it drops for any reason, that would be cause to maybe check out what's going on in your credit report. Now, the Discover It card, that comes free. You can see your credit score every month. They did that a few years ago, and a lot of other cards have followed suit. I know Citi now offers that as well, where on each monthly statement, they have a snapshot of what your credit score is. All right, now there's some guidelines that we want to talk about, and they're not hard, fast guidelines, but they at least give you an area to shoot for. So we're going to talk about the 2010 rule. The 2010 rule. The 20, it's saying avoid borrowing more than 20% of your net yearly income for any non-housing related debt. Okay. And now the 10 part of it is the payments on loans should not exceed 10% of your net monthly income. So with your net monthly income, only 10% should go to repayment of debt that's non-housing related. All right, so let's look at a couple numerical examples. Your yearly net income is $60,000, and your monthly net income is $5,000. So 20% of 60,000 means 12,000 is the maximum you should borrow for any non-housing related purchases. Now, $5,000 is my monthly net, and 10% of 5,000 means $500 is the most I should be paying back towards any non-housing related debt. So realize if all I can pay back is 500, I shouldn't be putting anything on my credit card above a balance of 500. So we're going to be doing more examples with the 2010 rule and also the cost of borrowing going forward. Today, since the video is quite lengthy, I'd like to leave the rest of the day for you guys to work on either your outline. You guys saw that I put a folder up for final project where you can submit your stuff there. Also, anything from the previous week, if you still need to get that to me, you can use the time today to do that. All right, have a good day, guys.